Ever wondered how to gauge the value of a stock while considering its growth prospects? Enter the price-to-earnings growth, or PEG ratio. This is a valuation metric that goes a step beyond the standard price-to-earnings, or PE ratio, by incorporating the element of growth. Let's start with the basics. The PEG ratio is calculated by dividing the PE ratio of a company by its earnings growth rate. The result is a single number that offers a more detailed picture of a company's value and potential growth. A PEG ratio less than 1 suggests that a stock may be undervalued given its growth potential, while a ratio greater than 1 indicates that a stock could be overpriced considering its expected growth. But why use the PEG ratio? Firstly, it balances valuation and growth. This means it helps investors to avoid relying solely on past data or short-term trends. Secondly, it's a handy tool for comparing companies. By comparing PEG ratios, investors can identify stocks with promising growth prospects relative to their current valuation. Turning our attention now to exchange-traded funds, or ETFs. There are certain ETFs that focus on companies with low PEG ratios, offering exposure to stocks that are reasonably priced and have strong growth potential. Take, for instance, the Invesco S&P 500 Pure Growth ETF. This ETF tracks the S&P 500 Pure Growth Index and selects companies showing strong growth characteristics, including low PEG ratios. Holdings include technology, healthcare, and consumer discretionary stocks. The iShares Morningstar Mid-Cap Growth ETF is another worthy mention. This ETF targets mid-cap companies with solid growth prospects and screens for low PEG ratios among its holdings. It offers diversified exposure to mid-cap growth stocks. Lastly, the Vanguard Small Cap Growth ETF focuses on small-cap companies with growth potential. This ETF emphasizes low PEG ratios and robust earnings growth, covering various sectors within the small-cap universe. Now, let's summarize. The PEG ratio is a metric that provides a nuanced view of a company's valuation by factoring in its expected earnings growth. It can help balance valuation and growth considerations and compare companies in a meaningful way. Certain ETFs focus on low PEG stocks, providing exposure to reasonably priced, high-growth potential stocks. Remember, while the PEG ratio is indeed a valuable tool, it is also important to consider a multitude of other factors and carry out thorough due diligence before making any investment decisions. And on that note, we wrap up today's discussion on the PEG ratio and low PEG ETFs. Happy investing!